Hello everyone, welcome back to our channel where we dive deep into the world of cryptocurrency. Today we're going on an exciting journey into the world of Bitcoin, the first cryptocurrency that revolutionized the financial landscape. We'll cover its history, decentralized nature, blockchain technology, and mining. Whether you're a beginner or looking to brush up on your knowledge, this video is packed with essential insights. So, let's get started and uncover what makes Bitcoin a technological breakthrough challenging our traditional views on money. Let's take a whirlwind tour through the key events that shaped Bitcoin. It all started in 2008, when Satoshi Nakamoto published a white paper titled Bitcoin, a Peer-to-Peer Electronic Cash System. Fast forward to January 2009, the Bitcoin network came into existence with the release of the first open-source Bitcoin client and the issuance of the first Bitcoins. The initial transaction was between Nakamoto and an early adopter named Hal Finney. By 2011, Bitcoin started to receive wider attention as more people began to see its potential as a decentralized alternative to traditional currencies. Despite challenges like price fluctuations and regulatory issues, Bitcoin's underlying technology, the blockchain, proved robust. The real turning point came in the early 2020s, when institutional investors started to embrace Bitcoin, viewing it as digital gold. This acceptance has propelled Bitcoin into mainstream finance discussions and cemented its status as a legitimate asset class. Now, let's dive deeper into how Bitcoin operates without a central authority. Let's unpack the concept of decentralization in Bitcoin and why it's a game-changer for financial security and freedom. At its core, decentralization means that no single entity or group has control over the entire Bitcoin network. Instead, it's maintained by a distributed network of nodes, each holding a copy of the entire blockchain. This structure is radically different from traditional financial systems, where central banks and financial institutions can influence currency value and supply. In the Bitcoin ecosystem, these factors are governed by preset rules in the Bitcoin protocol and the collective agreement of the network participants. One key mechanism that facilitates decentralization is the use of consensus algorithms. In Bitcoin's case, it employs the proof-of-work (POW) algorithm, which requires participants to solve complex mathematical problems to validate transactions and create new blocks. This process not only secures the network but also creates a fair way of issuing new Bitcoins through mining. Each time a block is successfully mined, the miner is rewarded with newly created Bitcoins. This incentivizes miners to maintain and secure the network. With no central point of failure, it's incredibly difficult for any malicious actor to alter any aspect of the blockchain. While Bitcoin transactions are public on the blockchain, they are not linked to the identities of the individuals involved, providing a level of anonymity. However, the lack of a central authority means there is no one to turn to in case of problems, placing greater responsibility on users to secure their own assets. This leads us to the backbone technology of Bitcoin that makes all of this possible: blockchain. Think of blockchain like a diary that's not kept in one spot, but copied across thousands of computers around the world. Each entry in the diary is a transaction, and each page is a block. When a transaction is made, it's broadcast to the network and validated by a group of nodes. Once a transaction is confirmed, it's bundled with other transactions to form a new block. This block is then added to the existing chain of blocks, hence the term blockchain. This process ensures that every copy of the distributed ledger is the same. This is crucial for maintaining the integrity and security of the entire system. Any attempt to alter a transaction already recorded in the blockchain involves not just changing the block containing the transaction, but all subsequent blocks as well. The decentralized nature of blockchain means that it operates 24/7, without the need for a central clearinghouse. This can reduce transaction times from days to minutes, and at a significantly lower cost compared to traditional systems. Blockchain's potential goes beyond just financial transactions, with applications in fields such as supply chain management, intellectual property rights, and even voting systems. Understanding blockchain is essential for anyone involved in Bitcoin, as it's the foundation upon which Bitcoin operates. With a solid understanding of blockchain, we can now move on to another critical aspect of Bitcoin's ecosystem: mining. Now, let's talk about Bitcoin mining. Mining in the context of Bitcoin refers to the process of adding new transactions to the Bitcoin blockchain. It involves solving a complex mathematical problem that requires computational power. The first miner to solve the problem gets to add a new block to the blockchain and is rewarded with Bitcoin. This reward incentivizes miners to invest their resources in maintaining the network and acts as a way to distribute new Bitcoins into circulation. Mining is also crucial for the security of the Bitcoin network. Each new block created during mining contains a reference to the previous block, creating a chain of blocks. Altering any information on a block would require remining not just that block but all subsequent blocks, which is practically impossible due to the high computational cost. The downside of mining is its environmental impact, with significant energy consumption. Efforts are being made to use renewable energy sources for mining operations to mitigate these environmental concerns. Mining is an integral part of how Bitcoin works and is essential to its structure and security. With a better understanding of mining, we can now explore how Bitcoin facilitates transactions between individuals without the need for intermediaries. Think about the last time you traded stickers or cards directly with your friends. No one else needed to say it was okay, right? Bitcoin works a lot like that. In a traditional financial system, if you want to send money to someone else, the transaction typically goes through a bank or another financial institution. This not only adds time and cost to the transaction, but also means that the transaction must be approved by the intermediary. Bitcoin, on the other hand, allows two parties to transact directly with each other without the need for a trusted third party. This is enabled by the blockchain technology, where transactions are verified by network nodes and recorded in a public distributed ledger. This ability to bypass traditional intermediaries is revolutionary, making transactions faster and cheaper while providing a level of freedom and privacy. Peer-to-peer transactions are particularly beneficial in regions where access to traditional banking services is limited. For many people in such areas, Bitcoin and other cryptocurrencies can offer an alternative means of conducting transactions and storing value. Now that we understand how transactions work in the Bitcoin network, let's look at the psychological aspects of investing in Bitcoin. Imagine you're trading cards with friends. You feel excited when you get a card you wanted, but sometimes if you trade away a favorite card in a hurry, you might feel sad later. Investing in Bitcoin can make people feel similar ups and downs. The price of Bitcoin can be highly volatile, leading to potential high rewards but also significant risks. This volatility can have a psychological impact on investors. The thrill of watching the value of Bitcoin climb can be exhilarating, but the stress from a sudden drop in price can be equally intense. Understanding your own psychological response to these fluctuations is crucial. Strategies such as setting clear investment goals, only investing money you can afford to lose, and not constantly checking the price can help manage the emotional roller coaster. Another psychological aspect of investing in Bitcoin is the fear of missing out, FOMO. Seeing others making profits can lead to impulsive decisions to buy or sell without proper research. On the flip side, fear, uncertainty, and doubt, FUD, can cause investors to panic and sell their assets prematurely. Ultimately, investing in Bitcoin should not just be about trying to make quick profits. It's important to understand the technology and the principles behind it. We've covered a lot today, from the history of Bitcoin and how it works, to why it's so secure thanks to blockchain and mining, and even how to manage the roller coaster of emotions that come with investing. If you want to keep up with the latest tips and tricks, and get exclusive buy and sell signals directly to your inbox, make sure to subscribe to our newsletter. Just click the link in the description below to sign up. Thanks for watching, and don't forget to like, subscribe, and hit that bell icon so you won't miss our next video. Until next time, keep learning, stay curious, and take control of your financial future.